Hi everybody, welcome to another episode of Stock Talk. My name is Aman. I'm an investment coach here at Sage Investors, and this is episode 53. And today I want to talk a little bit about ETFs. And ETFs are just the big thing right now in investing. We're seeing such a epic transfer of wealth that has been traditionally invested in very actively managed kind of investments like mutual funds, individual stocks, derivatives, and now we're just seeing this epic transfer of wealth into ETFs. And more people want to know a little bit more about, hey, what are ETFs? What are they all about? How do I get into it? And what's been happening is we've seen also with this epic transfer, one of the big reasons why ETFs are so popular is the cost. The cost of management fees for ETFs are much lower than traditional mutual funds. You're talking about paying like basis points, a couple like 0.05% on an ETF product versus 2-3% on a traditional mutual fund that invests pretty much almost like an ETF. And so there's been a huge transfer of money into ETF products, and with that, it has created a lot of competition with a lot of the ETF providers. Essentially, we're seeing a big race to the bottom in terms of costs. You're seeing some ETFs out there just like charging like zero fees now on some of their products, which is great for investors. That's a great thing. But the question is, how do these companies stay in business? Well, what we're seeing too is, as much as there's a big price war in terms of ETF costs, we're also seeing some companies are actually ETFs just kind of staying out of the fray, and they're choosing to go a different path. And what they're trying to do is differentiate themselves in terms of the type of products that they have. And more often than not, they're offering products that have a more actively managed component. They're ETFs that are just closet mutual funds that are actively managed in various different types of investing themes. Like you can find an ETF that invests in companies that are trying to eliminate obesity. You can buy ETFs that invest in social media companies. Now, often the premise with an ETF is that the performance of an ETF would be compared or benchmarked against a similar type of index. So if you're investing in an ETF investing in the S&P 500, S&P 500 stocks, the benchmark would be the traditional S&P 500 index. So what we're seeing now, though, is some of these ETF providers, traditionally relied on third-party indexes like the Dow Jones Industrials, the NASDAQ. What they're doing is adopting a process called self-indexing, in that the benchmarks that they're comparing themselves to, they're creating those benchmarks. They are creating, a benchmark that is, they think is a better representation of what the investments that they're making and should cover. And the premise and the justification that these companies are trying to do for going self-indexing is they have better control over the benchmark. It's cheaper to administer, and it enables them in a way, because it's cheaper to administer, they can charge more for it. And so you'll see higher costs for it because, as I said, these are businesses. They're trying to make money. So companies like Wisdom Tree, even Fidelity, they've released a whole line of smart beta type ETFs, have adopted this concept of self-indexing, and chances are it's not going to go away. And I believe if you do a little bit of your homework there, Vanguard, the so-called patriarch of passive investing, I believe have over the years subtly switched some of their benchmarks that they compare their ETFs to indexes that they can create and manage on it. So the question is, for investors, is this a good thing, or is this something, this is just the natural evolution of the industry and we should just, let it fly by? Well, the reality is, if you're controlling the benchmark that your product is being, your portfolio is being measured against, in a way you can tweak and manipulate that benchmark to suit your interests. So if you want to demonstrate you're outperforming, you can just tweak your benchmark, kind of to show that your portfolio is outperforming this benchmark and outperforming this index. It's kind of like tantamount to like moving the goalposts. So if you think your portfolio is not doing too well, but you might want to tweak your benchmark to make your portfolio look even better than maybe what it is. So having that, that arm's length ability to measure an ETF's performance, it's not there. And so the question is it objective enough, and is it credible enough? And are we going to see more of it? The other side of it too is that, this whole concept of fiduciary duty. Ultimately, ETFs and investment products are there to when you're putting your money with an investment product, with an ETF or a mutual fund, they're supposedly going to make investment decisions that are in the client's best interest. So is having a self-indexing component to your ETF really in the investor's interest, or is it more in the interest of the company and the shareholders, so that they can make their performance look better than it is, attract more money into the fund, make their assets under management look higher, so all the wonderful people who are managing those portfolios can get nicer bonuses? So that's the other side of it too. So to me, it's something, it's not there and it's not obvious. It's not something these ETF companies are going to go out of their way to tell you about it. You kind of have to dig in and do some of your due diligence when you're reading a prospectus, when you're reading an overview of a specific ETF, because you got to understand, are these funds, are you comparing apples to apples? And what we're seeing now is, the newer generation of ETFs are more actively managed now. They have an active managed component to it now. They're not like your traditional, ETFs of 30 years ago, where they would just be very vanilla, very generic, and compare themselves to broad-based indexes. So it's an interesting thing to keep in mind. It's one of the things I teach about in my course. I've developed an online course called How to Invest in ETFs, and I basically walk people through how to go about evaluating an ETF. And one element is costs, and another element is benchmarking and understanding and where to look for when you're reading a prospectus or you're talking to an advisor who's putting an ETF in front of you saying, hey, this is a really good ETF, you need to go into it, you need to take a look at. You can then ask a question, what's the benchmark against? What is it being compared? Is it being compared against a third-party arm's length benchmark, or is it the benchmark is being generated by the ETF company? Because if it's internally being generated, then you have to take the performance that they're generating with a bit of grain of salt, and then understand of it, because chances are, if it's self-indexed, chances are it's going to charge a higher fee. So these are some of the things I actually teach in my course, how to invest in ETFs. And so if you go to my website, you can take a look at it, and if you want to register, I'd be happy to. You can register. It's an online course, so you can take it on your tablet, phone, any way you want to do it. But it's an interesting concept now that's not getting enough play, and it's going to get a little bit more and more press relevance as ETFs are starting to become much more mainstream. So I thought I'd share it with you. If you have any questions about this, feel free to give me a shout. You can give me a shout through my Twitter handle @SageInvestors. I'm on there tweeting about all my various market observations of the day and my also personal investment decisions. Or you can hit me through my website, www.sageinvestors.ca, and hit me through an email through there, and I'd be more than happy to talk about this or any other topics I've talked about here in Stock Talk, or any future episodes of Stock Talk you want me to chime in and speak out about. So that's all I got for you today, and thanks again. Welcome to join for another edition of Stock Talk. My name again, Aman from Sage Investors, and we'll catch you again another time. Cheers. Take care.